Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is January 29, 2018, and based upon a request from a client, I thought I'd take a look at live cattle with the ETF being COW, cow, that being a long biased ETF, by the way. So what we have here is a mixed bag here with the trends. The short-term trend has been biased to the upside. Anybody that's been trading cattle for the last couple, 2-3 weeks in January, you would know that the trend is to the upside. But the intermediate and the long term are still biased to the downside. Obviously, they've got a different time frame, so we definitely have a mixed bag here. The technical rating, based upon a number of different conditions, are still negative cattle. Now, nothing is really popping up here in the elastic wave level or power level, but they have just recently, and they've just simply fallen off the board. The other thing I'll point out is that even though there's seasonal accuracy in live cattle right now, there's not enough strength to the market, so that's why it's not showing up. There is tendencies to the market. There is seasonal accuracy to the market. It's not simply showing up because there's just not enough of a movement. So let's take a look at cattle. Get a feel for what's taking place here. You can see these are daily bars here just to reference, and so here's today's action way in the far right, and you can see that in the recent days that the market has gotten overvalued, and now we've got a little bit of a bearish divergence where there's a high in the market and a high here in the indicator. We've got a higher high in the market, but we have a lower high here in the indicator itself, this being the elastic level. So there's a bit of a bearish divergence. So what you always do is you reference back to what was the market doing. Well, it did get overvalued, and you'll see here shortly that we'll be talking about the tightrope pattern, that the market is finding some form of resistance to the market. Now, as it stands right now, we're kind of in an energy zone, and this is a weak one at best, but I want to point it out. This 8 for this resistance level, if we take a look at where it goes across, that the market is finding a little bit of resistance all the way across through here. And if we take a look at a recent support level, this 10, again, what we'll do is we'll just simply pull this down. You can see that the market is ping-ponging back and forth between very weak, and albeit they're very weak support and resistance levels, that the market is setting up for some type of a move. And this is where the tightrope pattern is going to show up, and I'll show you that in a second. Now, with that resistance and support that we're in, the next level up here is going to be at 128 2/3. This is the next major resistance to the market. And if we really look at for any real strength or support to the market, that would be back over here, which is at 117 2/3. I'll call that right through here. So we really don't have major moves in the market. Yes, it's been a nice move since early part of January when our system started to go long the market, and they're still long and as a biased, but we are finding a little bit of resistance to the market. I'm going to flip back here real quick to the website and point out here's live cattle, and we had a high level in the T-rope. T-rope stands for tight rope, and what that represents is this. If we pull up a chart which has our power level, our power alerts, here is that tightrope indicator that popped up, and this is based upon a 200-day moving average and the interaction between the market and that 200-day. Now, obviously, through time, we have different interactions, but this one simply is interacting with the tightrope, or excuse me, with the 200-day moving average in such a way that we actually generated a signal which is causing us to really look at that 200-day as a form of resistance. And now we're in this energy zone. It's a low-level energy zone between those support and resistance levels, but you do have to be watching the 200-day, at least in this meter condition right now, as a form of resistance. Now, technically, we're long the market, which I'll show you, but I think that we're long-winded here, and that there's, based upon this interaction with the 200-day and some of the support and resistance levels, that there's a potential where we'll be liquidating that particular position. So if we again take a look at the website, I want to point out a couple things. Those support and resistance levels that I was talking about, they're weak, no matter how you look at it. We have strength, S, and C count, and these are weak numbers here. We only have a count of one instance, and the strength is 18, which is not super strong. We have a condition over here where we have a 2 count, 2 different levels of resistance to the market, and their combined strength is 60. But beyond that, there's really nothing that's really taking place. So there's not a tremendous amount of support or resistance to the market until we get to those outer extremes, those 50s that I was talking about. Anything between that is really not super strong. So the market could be quite volatile, and I'll point this out. With the seasonal tendencies to market, you can see that there's a bit of volatility into mid-March or so, but it's not dramatic. It's not like there's major swings to the market. We're talking relatively minor swings. This is the 5-year. On the 10-year seasonals, you'll see that it's even less pronounced, where the market is biased to the upside, but there's really not a lot going on here. So that resistance of that type rope and some of these other things could actually come into play, where we just could go into a bit of a consolidation. Now, what I'll point out is that the systems are long. One's been long since the 12th of January. The other one's been long since the 16th of January. So we've got 2 positions with some nice profits that are going on because of that trend. Now, the other thing I'll point out is that when you look at the basic account, we have 2 systems that are long, those 2 that I just showed, and it has a very nice profit. There's a difference between the basic account and the premium account as far as the way that we value the open profit. The detailed, we're going to look at it on our contract by contract basis. We're not going to normalize it because we want people to have the detail as to the name of the system and when it entered and the price and the type of system. We're giving a lot of detail. But when it comes to the basic account, we're just simply looking at what is the system doing, is it long or short, and not really giving a lot of information associated with it. But we do normalize the profitability based upon how it relates to a market. So I'll just simply show this to you real quick here since I have it. Here's our contract normalization, and we update this once every 2 or 3 times a week. So this was done as of last Friday, and here is the S&P 500, which is the primary market, where it has a weighting of 1. For every 1 contract that you would trade in the S&P 500, how many contracts would you trade versus the other markets that are actually out there? And obviously you have to trade them in normal terms. You can't take a fractional contract. And so in this case, here is a live cattle. It's 2.8. We rounded up, obviously, and so we'd be trading 3 contracts for every 1 contract that we would trade in the S&P 500. This is our way when we start dealing with our portfolio. How can we weight the different markets to make sure that we know that live cattle, as an example, is going to have a significant enough weighting within the portfolio if we're just simply trading a single contract. So if you're trading 2 contracts in the S&P 500, then it would be 6 contracts in live cattle. I think you get the idea. So that's just a way of being able to look at the contract normalization and really get a feel for what's taking place here. So when it comes to cattle, for the most part, we're seeing kind of a meandering type market. We're seeing some resistance with the type rope indicator that popped up recently. We're in a low level energy zone between those 2 levels that I was talking about when it comes to this 8 and this 10. And that there's a lot of or minor support and resistance to the markets. The wider support and resistance. This 50 and this 50 as an example are where the true support is to the market. So we would expect a meandering with a little bit of volatility based upon the 5-year seasonals, but the 10-year seasonals tell us that the market is even going to be a little more quiet. So how are we going to play this out? We're going to follow the systems. The systems, as I mentioned, are long the market. We've got 2 systems that are long. We recently liquidated some positions to underweight the portfolio, and so we were able to take advantage of that nice little swing, and we were able to liquidate the positions before that sell-off that we had here just the other day, or as that was actually taking place. So we'll see what does take place, but the advice would be, considering it's a relatively quiet market, we've got the energy zone that we're in. I would, for the most part, just simply follow the systems, watch and see what they have to show for us, and see as to whether or not we can't liquidate the positions and perhaps put our money into other markets if necessary, at least until we get into the latter part of March, mid-March or so. So that's the advice, and that's the info that we'll give tonight, and we will take a look at another market tomorrow. Thanks for watching.